Welcome to The Explainer. Today, we're unpacking a massive curveball thrown at United Airlines in their Q2 2026 earnings report and digging into exactly how they navigated what could have been a catastrophic financial roadblock. We're going to get into the raw data, the internal strategies, and the operational shifts that honestly defined one of the most interesting quarters in recent aviation history. Okay, let's kick things off with a number that would make any executive sweat: $6 billion. Based on oil prices from mid-July, United was staring down nearly $6 billion in anticipated added fuel expenses for the full year. This was all triggered by a totally unexpected, sharp oil price spike back in March. Now, in the highly volatile airline industry, a sudden multi-billion-dollar expense is usually the kind of massive headwind that just completely derails an entire year's forecast. So here's the multi-billion-dollar question of our explainer today. How on earth did United Airlines turn a potential financial disaster into a highly profitable, record-breaking quarter? Because they didn't just survive the shock, they actually posted a second quarter profit that totally beat Wall Street expectations and landed near the absolute top end of their guidance. To really get how they pulled this off, we've got to first understand the sheer scale of the fuel shock they were flying against in the second quarter. The consolidated operations data shows that Q2 fuel expenses shot up to just over $5.1 billion. To put that into perspective, that is a massive 84.1% jump compared to the exact same time last year. Basically, in just 3 months, they spent $2.3 billion more on fuel than they did the year prior. That is a massive hit to take all at once. But here is where it gets wild. You've got this 84% spike on the cost side, right? But despite that intense margin pressure, United still managed to push their total operating revenue up by 16%, landing at $17.7 billion for the quarter. They successfully recovered about half of that fuel increase in Q2 alone. So how exactly did they generate that kind of cash to cushion the blow? Let's break down the financials. The sheer volume of their revenue generation is seriously impressive. Total operating revenue surged from $15.2 billion in Q2 of 2025 to a whopping $17.7 billion this quarter. And this wasn't just a modest little bump or a lucky break. This was robust, systemic growth across their operations that provided the exact buffer they needed against the rising cost of jet fuel. To unpack how they achieved this, let's talk about TRASM. That stands for Total Revenue Per Available Seat Mile. It's basically the ultimate airline metric. It simply tells us how much cash the airline is making for every single seat they fly 1 mile, whether that seat is empty or full. It is the absolute best indicator of an airline's pricing power and passenger demand. Well, United's TRAS jumped by 12.1% compared to the same period last year. On top of that, their yields were up 12% during the quarter. What does this tell us? It shows that passengers weren't just continuing to fly. Demand was red hot, and customers were more than willing to pay for the product. That directly and effectively offset those violently rising fuel costs. And this momentum, it wasn't coming from just one place. United found strength across some very diverse revenue streams. I mean, an airline the size of United doesn't pull in $17.7 billion from just basic ticket sales. They were firing on literally all cylinders. Premium revenue jumped 16%. Basic economy was up 11%, which actually marks 2 consecutive quarters of positive growth for that cabin. Loyalty revenue climbed 11%. And then look at the logistics side. A surprisingly robust 23% jump in cargo revenue and a massive 27% surge in close-in contracted business revenue. Just incredible resilience across the board. Domestically, they ran the largest schedule in company history, doing a lot of the heavy lifting by raking in $9.5 billion. That's a 20% growth rate. But don't sleep on their international performance. Notice the nearly 19% surge in the Pacific region, too. The demand isn't just localized. We're seeing a global trend for the carrier. Now, you don't get these kinds of financial wins in a vacuum. They are directly tied to elevating the customer experience. CEO Scott Kirby really summed up the strategy perfectly here. He pointed out that when the oil shock hit, they adjusted their schedules, sure, but they simultaneously doubled down on customer investments. By spending money to make the flying experience better for everyone on the plane, from the luxury Polaris suites all the way back to the basic economy seats, they built brand loyalty that withstands economic turbulence. A massive, undeniable piece of that loyalty playbook is the Starlink Wi-Fi rollout. It is completely free for Mileage Plus members. Right now, it's already installed on 450 mainline and regional aircraft. They expect to hit nearly 1,000 aircraft by the end of this year, moving at lightning speed toward total fleet integration by 2027. They are aggressively pushing to stay ahead of their large U.S. competitors. And it is paying off big time. Giving passengers the fastest connectivity available isn't just a gimmick. The data proves it. Customer satisfaction scores on flights equipped with Starlink are literally more than twice as high as scores on their other Wi-Fi operating aircraft. It's a crystal clear line from capital investment directly to customer satisfaction, which circles right back to that revenue growth we just talked about. But let's be real, fancy Wi-Fi and comfy seats mean absolutely nothing if the planes don't actually take off on time. Check out this incredibly specific number. On June 18th alone, United safely flew 640,717 customers. That is a single-day company record, happening right in the thick of this fuel crisis. In fact, June saw the 10 highest volume passenger days in United's entire history. And the operation didn't even flinch. During these historic high-stress volume days, they achieved their best second quarter on-time departure rate since 2021. On top of that, they logged their lowest seat cancellation rate ever for a second quarter, excluding the highly unusual pandemic years. Even their newer hub, which, has had its fair share of challenges, posted its best ever on-time departure results for Q2. Having survived the fuel shock and delivered record operational days, what exactly is the flight path ahead for United? Well, they didn't just sit on their Q2 profits. They aggressively optimized their balance sheet, raising $3.7 billion in new liquidity through private bank transactions. Essentially, they bought low-cost insurance against further geopolitical uncertainty or another oil spike. At the same time, they prepaid about $1 billion in higher-cost debt. The speed at which lenders gave them this capital shows Wall Street is really buying into their ultimate goal, securing an investment-grade rating in 2026. All of this incredible maneuvering, the premium seat sales, the Starlink rollout, the flawless operations, the debt restructuring, gave leadership the confidence to do something pretty rare during a commodity crisis. They actually raised their full-year adjusted earnings per share guidance to between $9 and $11. They didn't just survive Wall Street's expectations, they completely crushed them. Which brings us to a really interesting question to ponder. After navigating a massive $6 billion headwind without compromising on customer experience or operational integrity, is United's path to that highly coveted investment-grade rating now practically an absolute certainty? It is going to be fascinating to watch how the rest of 2026 plays out. Thanks for joining us for this explainer. We'll see you next time.